Hello everybody, this is another update on the Gold Forecaster Index, the holy grail to predict gold prices. And let's see what gold did in the past month. We see that we have a huge surge here, and I gave a buy recommendation in March, so that has really panned out. I expect that gold will be breaking above the 1350 level at the end of the year, and I will tell you why this is. Now let's look at the gold forecaster index. We see that the latest data point here in April, we see that it ticks up again. So we are still above positive, above the zero line here. So we are in positive territory. Not that great yet, but I see a trend here going up. So probably it's a good time to be in gold. Same here, which is using the producer price index. The index is still positive. So it's not a strong buy, but it's a buy. Let's look at the economy now. Now, there's a lot I need to talk about in this video. So the conclusion is today that the economy is not doing well. When we look at the US economic indicators, we can see here that the employment is actually making a 9-year low here. It's still positive, you can see 27, but I think this will be going negative soon, which means we will go into a recession. Also here, the manufacturing PMI is going below 50, which means we will have a recession. GDP will be negative soon. Let's look at some other posts. Rate cuts. Yeah, this is the implied rate change, which is a cut of almost 1% by the end of 2020. And as you know, when we cut rates, that's bad for the US dollar and good for gold. Now, yeah, the latest news is that the US is putting tariffs on China, but also on Mexico. And as you can see here, these are the two largest trading partners of the US. So what we are seeing now is that the US tries to put tariffs on everyone, actually. And I expect that they will also impose tariffs on these soon. We also saw that India, Trump also put tariffs on India. So I see that we are going really protectionist here. And that's of course not good for GDP. GDP will be slowing down and inflation will go up. And I always say that tariffs are bad for efficiency. And if efficiency goes down, then yeah, you will get inflation because there is no efficiency anymore in creating the goods, trading. So that's what is going to happen. We will have a lot of inflation and slow growth, which is called stagflation. Another post here is, you can see that since 2008, Western central banks have stopped selling gold, selling their gold reserves. It's flat here. And Asia has been buying gold since 2008. So that's this rise here. So the central banks are actually taking in gold. That's a good sign. Let's see what we have more. This is a very important one. So this is a graph charting the budget surplus or deficit. and the revenue, the tax revenues. So this has always gone up and down at the same time. But since here, since 2016, we see that the revenues were actually pretty good, but the deficits, the budget deficits, have been increasing, so more negative. So what do you think will happen when stocks go down and the revenue, the tax revenues go down? So this deficit will be even larger. And each time when this goes down, we will have a recession. So the recessions are these gray areas. Let's take another post. This is also a very interesting chart about history. So this is the gold price in a logarithmic scale, and this is the stock market, the Dow Jones. So we have periods when the Dow Jones goes up and gold does nothing. Gold goes up and the stock market does nothing. Then stocks go up, gold does nothing. Gold goes up and stocks do nothing. The same here. And today we are at the top in stocks. Stocks are flat, and that means that gold will most certainly go up. So, yeah, I think these are the most important charts that I have. Um, yeah, here I have a chart about silver is doing a very bearish trend, but gold is going up and has a bullish trend. So I think gold is going to win this time, and silver will follow in about a year or two. Now let's look at some other charts. This is the leading versus coincident indicator, and we can actually see that the leading index is going up a bit. So I had expected worse numbers, but it's doing a bit better now. So yeah, not sure what is happening here. It could go down again, but at this moment the economy is pretty stable. But when you see all the other charts I posted, the economy is not doing that well. This is the bond yield curve versus Fed funds rate, and you see that the curve is inverting. It's already inverted now. This is the 10-year minus 1-year treasury, and you cannot stop this trend easily. It's going to overshoot here, and the Fed is already putting the Fed funds rate at 2.4, but I don't expect them to cut it soon. Maybe in September they will cut it. Typically there is a lag here. So you see the Fed funds rate always flattening out here. Then we overshoot, and then they start cutting rates. And at that point, the yield curve will go back up, and then the recession starts. So I expect the same to happen now. That's an overshoot, a rate cut, and then we will be off to the races. And each time that this happened, gold is going up in 2000, 2009, and also in about a year or two. Let's look at the treasury yields. So this is a very ominous sign. You see that the treasury yields are really crashing down below the Fed funds rate at 2.4. And yeah, this looks very recessionary. So the Fed needs to cut rates soon because at this pace we will be very inverted. Let's look at the producer price index. That's the blue line. So there's not a lot of inflation here. So I don't expect too much inflation at this point, but when they cut rates and initiate QE again, this could go up very soon, maybe at the end of the year. Now, this is also an interesting chart. This is the deficit to outlay ratio. We already talked about the deficit, which was going up very strongly. And you can see that this ratio is going up. The deficit is actually increasing against the outlays. And that measures how many, how much the government spends, outlays, and how much is borrowed from foreign money. And this is really going up. And I think it will keep going up because the deficit is growing. So they will borrow more and more money to do the government spending here. And if this goes to 40, then there's a high risk of inflation or hyperinflation. So this chart needs to be monitored. Now we have the deficit numbers here. So the latest number here on the trade deficit was actually positive. It's still in a downtrend, but it's not going down more in April. But when you look at the budget deficit, which is this yellow line here, it's crashing. They have a lot of budget deficits. So I expect that the trend will be going down. You can see here also in 2008 when this crashed, the red line would also crash. It's inevitable. Let's take a look at the capacity utilization rate. This is going down. So not too much inflation is seen here in the US because capacity is not going to 80%. And I think the reason for this is that there are just no sales. And this is the business inventories to sales ratio. So when this blue line goes down, it means there aren't any sales and there are too many inventories available. So they don't need to produce anything. And that's what happened here. In June 2018, it went down. The same here. Uh, Somewhere in September 2018, it started to go down. And I think that sales will be going down more. And that's when Trump started the tariffs, the trade war, in July last year. Then these things went down. More and more inventory and less sales. Now let's look at the gold versus the 10-year yield adjusted to inflation. And that is the blue line. The blue line is going down. So we have a real rate that is going down, which is good for gold, which you can see here in the red line. This is going up. And I expect that this blue line will be going down even more. And why is that? Let's look at the 10-year yield here. This is really crashing down. So in the coming months, this could go even lower and the yield curve could invert even more. So this is a very good environment for gold. Okay, if you look at one of my previous videos, I recommended to buy Grand Colombia gold. It's doing very well. It's almost up 20% already. So you can go into physical gold, but gold stocks, gold mining stocks are also very cheap. Okay, I'll see you in the next video.